Let's jump right into this explainer. If you've been watching those massive, out-of-nowhere market moves, like Bitcoin ripping from 15K or gold just suddenly shattering all-time highs, you've probably wondered who exactly is pulling the strings. Well, you're absolutely not alone in that. Today, we're totally decoding the secret matrix behind these massive asset moves, specifically zeroing in on two absolutely crucial phases: accumulation and distribution. Okay, real quick, here's our roadmap. We're going to cover the smart money matrix, break down the anatomy of accumulation, look at the fake breakout trap, map out distribution phases, dive into indicators, and finally, wrap up with risk and trading psychology. Let's get to it. Section 1, the smart money matrix. Because, and we need to establish this right off the bat, markets do not move randomly. They rotate through deliberate, repeatable cycles.
Let's be real for a second. How many times have you been staring at a chart and asked yourself, why on earth do breakouts always seem to fail the exact second I buy them? Right? You see a resistance level break, the FOMO kicks in, you jump in, and literally instantly the price reverses and stops you out. It is the most frustrating feeling in the world. But here's the thing. That's not bad luck. It's actually a highly intentional tactic known as liquidity hunting.
To really grasp liquidity hunting, we've got to look at a true pioneer in technical analysis, Richard D. Wyckoff. He proposed this wild idea that we should view all market fluctuations as a deliberate game played by a single, immensely powerful entity. He called him the composite man. Think of this theoretical giant as the smart money, sitting behind the scenes, meticulously building massive positions and manipulating the board to your disadvantage if you don't know the rules. But if you do understand the game, well, it can be to your great profit. There is a massive psychological divide between the players here. Retail traders, we tend to get emotional. We trade the choppy, messy middle of a range, and we buy high because the FOMO is just too real. Smart money, though, they are infinitely patient. They sit back and they buy the sweep below support. They are actively hunting for the exact liquidity that retail traders unknowingly hand over when their stop losses get triggered. It's a psychological chess match, for sure. Section 2, the anatomy of accumulation. This is phase 1 of the cycle, usually creeping up right after a brutal, drawn-out downtrend. So how does the composite man actually accumulate assets at rock-bottom prices without anyone noticing? It's a pretty specific blueprint. First, price just grinds sideways in a super tight range. It's incredibly boring, and retail traders completely lose interest. Then, boom, you get multiple fake breakdowns dropping below support. And finally, you start seeing this gradual shift, forming higher lows right before the actual legitimate breakout kicks off. Those fake breakdowns, they are absolutely crucial to understand. That is liquidity hunting in action. You see, when massive institutional players need to buy millions of dollars of Bitcoin or gold, they can't just smash the buy button. If they did, the price would skyrocket and their average entry would be terrible. So instead, they deliberately push prices down past obvious support levels. Why? Because that is exactly where retail traders park their sell stop orders. Triggering those stops creates a flood of sell orders, which is the exact liquidity the smart money needs to quietly fill their massive buy orders. So those terrifying giant wicks on your chart, yeah, that's just smart money sweeping for liquidity. Section 3, the fake breakout trap. This is where the most obvious moves are actually meticulously crafted illusions. Welcome to the manipulation phase. Smart money triggers those retail stop losses, grabs the liquidity, and then a rapid price reversal violently whips right back into the sideways range. On your candlestick charts, this usually prints as a doji or a hammer candle. A huge long wick proving the price was shoved down, grabbed the liquidity, and was instantly bought right back up. It creates this total illusion of a brand new trend, baiting breakout traders right into the trap. They get chopped to pieces while smart money just finishes loading the boat. Now, this next concept completely flips traditional trading logic upside down. Most retail traders sit around waiting for a massive breakout to enter, right? They think, oh, finally, this is the start of the move. But for the composite man, that explosive breakout is usually the final move of the setup, not the beginning. It is the grand finale of months of quiet accumulation. If you're buying that initial massive breakout, there's a huge chance you're just providing the exit liquidity for the smart money's early entries. Section 4. Spotting distribution phases. What goes up must eventually come down. So what happens when that explosive trend finally runs out of gas?
Distribution is literally the exact mirror image of accumulation. It's how smart money safely exits their huge positions without completely tanking the market all at once. Step 1. A sideways range forms right after a massive euphoric rally. Everyone is thrilled. Step 2. You get these multiple fake breakouts spiking above previous highs, hunting for that buy-side liquidity. And Step 3. Lower highs start creeping in as the buying pressure finally completely exhausts itself.
The ultimate trick here is the illusion of strength. While retail buyers are feeling on top of the world, reading insanely bullish news, watching the price hold near all-time highs, the composite man is quietly handing them the heavy bags. Smart money distributes their positions to the late, overly euphoric participants while meticulously making the market look flawlessly strong. It is a literal masterclass in deception. Section 5. Indicators and phase identification. The good news is we don't have to guess. We can use traditional tools to figure out exactly which phase we're dealing with. It's crazy how your favorite indicators behave so differently depending on the market cycle. During accumulation, price is just going sideways, the RSI is chopping around between 40 and 60, and the MACD is basically flatlining near zero. But in an expansion phase, the trend is super clear, RSI holds high between 40 and 80, and MACD expands away from zero. Now distribution, this is where you gotta be careful. Price might push to weaker highs, but the RSI will actually diverge, failing to make new highs, and the MACD starts printing lower highs above zero. Finally, the reset phase hits with a sharp reversal in extreme RSI levels. Context is everything here. The phase totally dictates how you read the indicator.
There is a super painful truth to this quote. Most losses come from being right about direction, but wrong about phase. You could be 100% right that Bitcoin is heading to a new all-time high. But if you try to force a breakout trend strategy while the market is literally still stuck in an accumulation range, you're going to get chopped up. Your account will get totally drained by fakeouts way before the real move ever even happens. You absolutely have to align your strategy with the current phase.
Section 6. Risk and trading psychology. Let's talk about how to actually protect your capital and your sanity now that you can see this hidden matrix.
Surviving these cycles takes unbelievable patience and incredibly strict rules. Number 1, just avoid trading inside the messy middle of these ranges unless you have rock-solid confirmation. Number 2, wait for the actual breakout and ideally wait for a successful retest of that level. Number 3, when the market is consolidating, drastically reduce your position sizing. Protect your capital. And lastly, whatever you do, don't give in to FOMO during those boring sideways markets. That boredom, it is literally by design. It's meant to make you drop your guard.
I really want you to think about this next point. It is always easiest to buy at the absolute wrong time, when a trade feels incredibly comfortable, when every headline is totally positive, and there is zero fear left in the market. That is almost certainly when you are buying the distribution top directly from the composite man. Honestly, the smartest trades usually feel the most terrifying to execute, like buying that horrifying liquidity sweep right below support during an accumulation phase. So, to wrap up this explainer, I want you to mentally pull up your own charts. Now that you're aware of the hidden structure of liquidity hunting, fake breakouts, and the composite man's playbook, ask yourself, which phase consistently tricks you the most in real-time trading? Is it getting chopped up in the boring trap of accumulation, or getting caught holding the bag in the euphoric deception of distribution? Figuring out your own blind spots is step 1 to mastering the matrix. Thanks for hanging out with me for this explainer, and definitely keep your eyes on those charts.